Lawyers, technologists, and entrepreneurs, the firm's partners began their journey in the crypto industry by building and operating cryptocurrency mining machines and private digital asset investment fund. They quickly realized that the industry was woefully underserved by legal professionals who grasped the impact of blockchain technology that would eventually change the world. Bull Blockchain Law LLP was founded to support the growth of new breed of technology. Today, the firm serves as counsel to clients of all sizes and advocate for sound public policy. It remains one of the few law firms completely focused on the crypto industry. We're fortunate enough to have Tyler Hartcraft from Bull Blockchain Law on our next panel. Our next panel brings together the experts in the legal and regulatory landscape. But since blockchain is a global technology, we need to consider the global landscape of legal and regulatory considerations. To help us understand the topic, please welcome our next panel, moderated by Eric Guthrie. Eric.
Good morning. Excuse me, I said good morning. That's what I'm talking about. I am Eric Guthrie. I'll be moderating the panel. And we're going to be talking about some exciting things in the regulatory and the legal sector. But before we start, I'm going to have the panelists introduce themselves, because I always believe that you always do your best job when you're selling yourself, right? So I'll start. I am Eric Guthrie. I am the Director of Training Programs for the Government Blockchain Association. I'm also a partner in the Cogent Law Group, a fintech firm right here in the DC area. I'm the author of the book Blockchain or Die, Amazon #1 bestseller 5 times and winner of 3 book awards. And I have a new book coming out, the sequel to Blockchain or Die, in the fall of 2023. So that's me briefly. I hope to interface with as many of you as I can in the next 2 days. This is a wonderful conference. This has been going on for so many years, so I always look forward to it every year. And I'm going to pass it to Gabriella.
Hello. Thank you very much for the warm introduction. My name is Gabriella Kusz. I'm the CEO of the Global Digital Asset and Cryptocurrency Association. We represent small, medium, and some of the larger names in the digital asset space and have over 90 member firms focusing on education and certification, standards and guidance, and also advocacy.
Hello, everyone. My name is Chris Groshong. I'm the president and founder of Coinstructive. We do 3 main things. Mostly, we focus on compliance as a service, so I act as a fractional compliance officer for several crypto financial institutions. And then we also help them get money transmitter licenses as well, so we're very legal ancillary. And then the cool thing that we do that everybody likes to talk to me about is the crypto private eye work that I do. So we do crypto fraud investigations. We work directly with victims and law enforcement to try to help victims recover their assets. And that's where the fun stuff comes in.
Yeah, that does sound fun. Hi, good morning. I'm Mike Kanovitz. I'm CEO of Jurat Blockchains. We are a legal tech company that provides solutions for connecting courts to blockchains so that decentralized systems can benefit from basically from the law. And so we do that in ways that are respectful of decentralization and promote the ability to resolve smart contract disputes, property disputes. If you lost keys, a court can help you out. And we have a layer 1 blockchain called JTC and are creating other ones.
Hi everyone, I'm Tyler Hartcraft. I'm a partner at Bull Blockchain Law. We're a boutique law firm based in Philadelphia, launched in 2018 that focuses specifically on working with blockchain and crypto clients. So we do corporate and regulatory work for service providers, layer 2s, dApp developers, DAOs, pretty much anything corporate and regulatory focused with a blockchain and crypto slant to it.
And just how you know how dedicated these panelists are, Chris, are those Bitcoin socks?
Yeah.
Bitcoin socks,
Those are
folks.
Bitcoin socks.
That's what I'm talking about. Mike, are those Ethereum socks?
They are Ethereum socks.
What a panel, right?
we did not call each other up this morning, and we both decided there's room for both of us.
We're not sitting on opposite ends of the panel.
So for those of you that see me do panelists before, you know how I like to start. I want to see who's in the audience. So I'm going to ask some questions so we can kind of get a gauge of who's in the audience, and then we can, we can gauge our discussions from there. How many of you are in the corporate/private industry when it comes to blockchain technology? Raise your hand. Okay. How many of you in a nonprofit space? Raise your hand. Okay. Education? Okay.
Oh, wow, cool.
I'm sorry?
Cool.
Yeah, okay. How many of you have an actual blockchain product or project that's successfully completed? Raise your hand. Okay. How many of you have a token or cryptocurrency? Raise your hand. Okay, good. How many of you are in the planning phases but have not yet rolled it out yet? Raise your hand. Okay, so we have one. All right. So that's two. So that's helpful. All right, you guys got that? Oh, one more question. How many of you from outside of the U.S.? Raise your hand. Okay, so we got a couple in here. So I ask those questions because I like to make sure that we tailor our conversation to the needs of the audience. And I'm going to read a quick statement to kind of get things started, and then we're going to go into our panel. According to the World Economic Forum, there are 18,000 cryptocurrencies right now, 460 crypto exchanges, and the total market value is 1.7 trillion. We've come a long way in a very short period of time. The potential implications for cryptocurrencies for global financial stability and the distinctive nature of the underlying technology evidence the importance of prioritizing regulatory discussions and decisions both at a national and a global level. According to the World Economic Forum, there's been no international coordination and regulation of cryptocurrencies. Actually, we have an addition to that may change with our MICA discussion. However, central banks and regulators have their eyes on this growing trend. For those countries, their objectives appear to broadly align: protect the customer, prevent illicit financing, protect the integrity of their markets, and promote innovation. For a truly coordinated approach, countries and international organizations must work together, leveraging best practices and learning from each other. This includes conducting assessments and establishing common standards, like, for example, the blockchain maturity model. We'll get to that later on in this conference. So this sets the stage for our panel. We're going to break it down into three sections. The first panel discussion is going to be on the global regulation and regulation of cryptocurrencies and blockchains. The second is going to be on a national level here in the US. And the third is going to be on a local level, especially two states, California, Illinois, for example, are going to be two that we've discussed in our prep sessions to discuss today. So here's the first question, and this one is from Michael. There's been a lot of talk about CBDCs, central bank digital currencies. It's even mentioned in the executive order that President Biden rolled out in 2021. Can you briefly just explain to the audience what a CBDC is, and can you give an update on the CBDC in the US right now?
Sure. So CBDCs are a monetary instrument that are developing on an international level, far more so in other countries like China than currently in the US. We're years away from having an actual CBDC and even really knowing exactly what a US CBDC would look like. Nevertheless, it was a sleepy topic up until it got to be election year, and now you're probably hearing a lot about CBDC in the US, and it's being positioned as a civil rights issue. And to understand why that is, let me just explain briefly what a CBDC is and will be. It's a tokenized dollar that is created by the Fed, and it can exist and be used at a wholesale level, basically for transfers among banks, but it also has the ability to be used at a commercial level. And that's where it gets controversial, because if the Fed creates a tokenized dollar at the commercial level, that will be merged with the payment system. So right now there's digital dollars. You have credits in your bank account that are solely electronic, and yet they're a dollar. And if you want to spend that, you go through the banking system. But a consumer level CBDC would create an account for you directly at the Fed. And if you wanted to spend it, the transaction would go up to the Fed, down to credit whoever's account you're paying on a centralized ledger maintained by the Fed. And where's the role for the banks? And so banks obviously are taking a very sharp interest in shaping CBDC, and because of the powerful nature of what it can do. One of the main criticisms that are being floated around is the issue of privacy and ultimately concern about government control, because if you have an account directly with the Fed, then the federal government knows what you're spending your money on, and potentially, and again, nobody's said exactly how these systems are going to be constructed yet. We don't even know if it'll be on a decentralized ledger or a centralized ledger, but the Fed or government officials potentially have the ability to decide what you're going to spend your money on, and could potentially stop you from spending your money, or decide that if you spend it one way, you're going to be better off than if you spend it another way. So we are actually starting to see bills being introduced. The bills at the congressional level have gone from, hey, this is really interesting. Let's look at what's happening in the rest of the world, and let's study how it might be implemented in the U.S. in ways that protect our banking system, all the way up to forbidding the Fed from ever offering a commercial level CBDC, which of course would be very protective of the banks. It's even gotten, and you probably heard about this, that Florida has passed a law now, signed by DeSantis, which says CBDC does not meet Florida's definition of money, which is really interesting from a federal perspective, since Congress is the one that decides what meets the definition of money or not, and Congress created the Fed. But that should give you an idea of how controversial this topic is, and I think we're only going to see it get worse, the controversy.
Any other thoughts from the panelists?
Yeah, I mean, there's other states too that have objected in addition to Florida's ban. I mean, we have Alabama, Louisiana, I think North Carolina and Texas also. So it is a pretty divisive issue among the states and among the political divided parties. Censorship being, you touched on censorship being the primary issue from the standpoint of, a con that's argued for it. Governments mostly are arguing, as you said, that it's really an opportunity to comply better with international sanction standards, combat money laundering and terrorist financing. The primary opponents to that are really saying, how has that gone for you with the existing anti-money laundering laws that have abridged privacy up until this point? And so there's a tug and pull with the privacy argument for sure.
All right, so let's pivot to our next global question, which involves the European Union. On May 16th, the Economic and Financial Affairs Council of the European Union gave the green light to the highly anticipated Markets in Crypto Assets, what we call MiCA, regulation. 27 member states agreed to MiCA, and this is very recent. It happened in late April of this year. So this is almost, like hot off the press here. So I'm going to ask the question about MiCA, but first let me make this point. 27 European nations agreed on one regulation, one regulatory standard, and the U.S. can't even do that, and we're one country. So just putting it out there. So I'm going to go to Michael again to talk about MiCA, and then other panelists can add on.
Yeah, so I'll pick up where Eric left off. MiCA is really a study in contrast versus what's been happening in the U.S., where we're regulating by enforcement. We've got agencies with overlapping jurisdictions and just general chaos on the topic of digital assets. And MiCA, having been adopted by the EU, probably is going to set the standard and the thought process for how we will eventually get regulatory clarity in the U.S. So MiCA basically creates three classes of digital assets. E-money, which is what we would generally consider to be a stable coin. It's a token that is pegged to a fiat currency. Something called ARTs, which are asset referenced tokens. And so that's sort of like a derivative. It could be a basket of currencies. It could be stable to another cryptocurrency. So I don't know how many of you play around in DeFi, but there's this concept of a wrap token basically where I give my crypto to a custodian on one blockchain, and then the custodian gives me another coin on a separate blockchain. So that's an example of something that would be regulated as an art. And then it covers utility tokens, which are classically these instruments that I can use to spend, but only with the issuer. It gives me some right to claim services or goods or something along those lines. What it doesn't cover is securities aspects. So you won't see Bitcoin or Ethereum being regulated under MiCA. That is still being left to the securities laws of every country. And query why that is. One is, I think that MiCA is really mainly focused on payments because of the power that blockchain has for improving the payment system, making it cheaper, making it more accessible, and making it 24/7. But also because the security problem is just a hydra where every time you think you've got your arm, you've cut off a head, and you think you know what you're doing, the technology morphs, and now you're not sure what you're looking at. So under securities, we're still doing the buggy whip regulation now that we've got supercars. So,
Chris, Gabriella, you want to add anything?
Yeah, I think, you kind of have put forward sort of an interesting contrast, one country versus numerous countries that are able to come together. I think one of the pieces that, I consistently hit on is the importance of, being able to be a convening force, especially at a global level. And for a long time, especially from a traditional financial sector perspective, the United States has, very heavily been in the driver's seat. And what we're seeing, I think, again, like when we talk about digital assets and when we talk about blockchain technology, is, not only the disruptive power at a, individual jurisdictional level when it comes to financial sector evolution and transformation, but really the disruptive power that this has as it begins to blend into how we see things turning out from a geopolitical or global leadership perspective. In this instance, I think you've seen the European Union come out very strongly. And again, there are both supporters as well as detractors to components of EU MiCA, but for better or for worse, it is there. There is now a certain degree of clarity. The ambiguity is dissolving around how and in what way digital assets will be treated. And so if you are a high quality player from anywhere around the world who's seeking to engage with a vibrant and dynamic financial sector, you have heard the siren coming from Brussels. That is a call for clarity that allows for you to build with comfort and with confidence. And it's true, it's not perfect, but there's no jurisdiction, no legal or regulatory environment that is ever perfect. But it's going to act a bit as a magnet to pull high quality firms that are looking for that legal and regulatory clarity so that they know that the time, effort, energy, and investment, quite honestly, that they're putting into some of their products is going to be protected. And I think, this first step in, lockstep behind, I'd say, Switzerland, Singapore, the UAE, I think every day, every week, every month, the US gets left further behind. And the pace of change and evolution is so rapid, and particularly here, that I think it is critical. It's quite an imperative for something to get passed in this legislative session.
Now, you make a interesting point that the comfort, the clarity, the confidence that MiCA provides, those are all very much pros to MiCA. Are there any cons or any concerns with regards to MiCA that you could share with the audience?
So I think, me, yeah, is that okay? I'm like, I talked a
We'll
lot.
start with you,
I'm
but
happy.
anybody.
Again, I think you see people worrying about some of the potential impact, especially in the evolution of a truly decentralized financial field. I think you're also finding some of the approaches to be, from certain perspectives, overly heavy-handed. Again, some of that is going to be balanced with where on the spectrum you're building in terms of, specific industry vertical. But I think further, your openness for and tendency or affinity for privacy versus AML KYC provision of information, your function or utility in the digital asset space when it comes to token versus stablecoin versus crypto straight play. I think those are pieces that, if we're looking at points for criticism, that emerge. But I think ultimately some of this is still yet to be spelled out, because although you're going to have passage at an EU level, now what's going to have happen is that this will be adopted and implemented down by each of these different jurisdictions. And so similar to the EU non-financial reporting directive, similar to some of the legislation that you've seen passed with regards to the EU 8th directive, some of these pieces that come down, it's going to be tapered and tailored to some of the unique country context that happens throughout those, how many now? 30 plus countries. So this is something that I think people need to keep into consideration. It's not 100% of a done deal. There's always elements of tailoring that happen around the adoption and implementation phase. And I think that's where you're really going to see some of the individual European countries be able to stake out, differentiate, and perhaps draw, and help to lead within the EU when it comes to, positioning.
So I'm just going to add that I've already seen this taking place like firsthand, like because there is clarity this quickly, right? It's only been like a month. I have a client who is already getting licensed in Europe as a VASP, right? Virtual Asset Service Provider, so that they can do what they wanted to do here. Like, it's happening. Like, our lack of clarity is really disrupting innovation, and everybody in this room has been saying this, right? Like, this will destroy innovation. This will just break down this whole industry for us and keep us out of being where we usually are, at the top of the podium. And unfortunately, right, I wasn't sure that okay, well, so they're going to open this up. It's going to make it easier for. Are people really going to actually take advantage of it here from the U.S.? Well, they are. So. It's interesting to see how quickly, right? As soon as the clarity happened, people are moving, right? Because it also allows them to be able to open up to other jurisdictions outside of the EU as well. So now it's not just the EU, right? But it's all of the Middle East or parts of Asia, right? Central South America. And these things are what these companies want to do, because crypto companies, for the most part, are global, right? And the global ones, actually what's happening, I'm seeing, is businesses from outside the US are now looking to open up shop here, because they've already established businesses in other jurisdictions that are safe or stable, and they now feel like they can take the risk to come into the US, whereas other companies are now leaving the US. So they're seeing an opportunity now, even though it's more risky. So we're displacing local companies or companies that are being built here by companies from overseas coming in now. That's exactly what has happened, which I think was counterproductive to what we were intending in the first place.
I think too, more to your point, and just to kind of piggyback off of it, but this idea of the speed with which people are offshoring. I think it's interesting because a lot of times when you speak with legislative offices, as we do on behalf of the Global DCA and our members, a lot of times it's like, well, this is just another alarmist, people will offshore. Remember, in a post-COVID world, in a highly fintech-oriented industry, you don't need to move offices, people, operations. You can offshore in a month or less. And we work with different consulates. Happy if you're from one of the consuls to sit down and talk with you, because our member firms are all vetted and they're high quality firms. And so people come to us and say, we are willing to work with you on economic development incentives packages. We're interested to provide tax benefits and assistance. Our goal is really to position with a race to the top for a lot of these jurisdictions. And I think, maybe there was a lot of worry in congressional offices about this being a cry wolf. But in an industry that's so new and emerging, which hasn't had deep roots in any country in particular, the ability to so easily and seamlessly shift jurisdictional affiliation, and the speed with which that can happen, you really, if you're a country that's serious about this, which there are many of them, they recognize that digital assets in particular are the first and most sophisticated use case of blockchain technology. And so whether they care about digital assets or not, they very much care about the underlying blockchain technology. And so they're very interested in courting, providing support, and welcoming people with open arms so that they can have that level of leadership, which they know will exist into the future.
So speaking of shifting, we're going to shift from global now to national. So this conversation, this part will be based on what's happening in the U.S. And we're going to start with a hot topic that's actually arguably led to one of the reasons why we had the crypto winter that we're currently in, stablecoins. Stablecoins, right? I'm not going to say the coin, but most of you in this room should know what happened and which one was involved. And I'm going to ask the panelists, whoever wants to start, please feel free. Give us an update on what's happening with stablecoins in the U.S., and what do you see for the future of stablecoins in the next 5 to 10 years? But not all at once.
So
Tyler.
there was just, I believe, a subcommittee hearing last week on stablecoins, and there's a bipartisan act on the table. It seems like the parties are coming together to agree on how we should regulate stablecoins, which is a huge important point for our country and for the technology. And it's great that we're isolating specific issues and making advancement on really specific issues, because there's so many issues that are present that they can't all be addressed in one rewrite of a law or in one new law. And so we need practical fit for purpose laws for each use case. And so what's happening right now is there's a debate as to how this law should be enforced, whether it should be at the state level and there should be kind of sort of a money transmitter licensing type of enforcement and licensing regime, or if it should be more of a federally based enforced law. And so there's a debate about federal minimum standards plus state licensing, or if this should just be a federal issue. And so, I think it makes sense to come at it from a federal perspective, and there's a lot of enforcement mechanisms available, and the stablecoin law, if it's passed, it's going to be a great stride forward on a very specific issue that's built for market integrity, built for customer protection, and those are really the important issues that are honed in on right now.
So one of the discussions about stablecoins as a part of that act is that they have to have the same backing and pass the same stress test as a bank does. So do you think that gives stablecoins a too high of a bar to reach, and that therefore it really invalidates the whole concept of a stablecoin?
Well, yeah, it's a double-edged sword, because we do want assets to be properly protected, and so there's requirements that there are certain minimum assets that you have to hold, and not only minimum assets, but the type of assets that you can hold. So we all saw the debacle with what happened with algorithmic stablecoins and other stablecoin issuers not really protecting or custodying funds properly, or misusing funds or diverting them for investment purposes. So obviously that is bad, and we don't want that. We want regulations that enforce that. And so, but to your question about whether we hold stablecoin issuers to the standard of a bank while not calling them a bank, I think it really depends on exactly what those standards are, because there's a lot of different requirements that banks are subject to that don't necessarily apply to stablecoin issuers.
Okay, any other thoughts for the next question?
I'll just say something really briefly. I don't know that that's a solution to the problems that we face with stablecoins.
Right.
Most of you probably have heard of USDT, which is Tether. There's also the second largest stablecoin is USDC, which is issued by Circle. And the idea with a stablecoin is you want to constantly be pegged to the underlying asset. For both of those, the dollar. And Tether gets a bad rap because people don't know exactly what's on its books. USDC is backed dollar for dollar by audited deposits in a bank account. So you'd think USDT, not stable, USDC stable, but then USDC came off its peg 2 months ago when the banking crisis started, because nobody knew for sure if Silvergate Bank goes out of business, maybe USDC is no longer backed dollar for dollar. So there's concerns about contagion. There's concerns about how rapidly these payment mechanisms can cause assets to transfer between banks. And so I don't think that regulating the issuers as banks is a sufficient solution in itself.
I think that's an important point too, because that's a broader banking risk and financial stability risk rather than a crypto-specific risk. And so when we look at things like what happened with FTX and with some of these banks, they're not necessarily crypto-specific risks. FTX was outright fraud. That can happen in any industry. What happened with these banks, that's more financial instability and mistrust on the part of the depositors. And so I think there's been some characterizations as to these problems as strictly crypto problems, and I don't necessarily agree with that.
All right, so we hit stablecoins. Now let's hit CBDCs in the U.S., which is under the purview of the Fed, or at least it's supposed to be. What are the updates that we have for CBDCs in the U.S., and what is the role that the Fed is playing when it comes to rolling out the next CBDC, or the first CBDC?
Well, there's a lot of pushback, actually. There's a couple bills that have been introduced to specifically not allow CBDCs to exist, so that the Fed can't issue them, and no Federal Reserve Bank can issue it. So, two separate bills. So you can. That goes back to what we were talking about earlier about CBDC. There's a privacy concern. There's a surveillance concern. There's a real issue around the control of money, right? And so as soon as it becomes digital, as soon as it's issued by a government, it changes the perspective. We can see what's happening in China, right? We don't really want a social score, and which then allows us certain privileges to like go to certain stores or buy certain things, or it really is possible. It's very easily a tipping point to a complete surveillance society. And so that I think for a lot of folks is very concerning.
Let me just stick up for the regulators for a minute. The central bank.
No, boo.
There's got to be somebody who's putting their head down in the back there. These people, at least in this generation that are trying to create the stablecoins, they don't want to have to mess with your private information. They don't want to have the responsibilities of deciding how you can and can't spend your money. They want the benefits that CBDC can offer. For example, financial inclusion. If a bank can't figure out how to profitably bank someone, well, they don't have access to a payment system at all. By contrast, if everyone can simply establish an account at the Fed, that's inclusive. If everyone has an account at the Fed, then there literally cannot be a run on the bank. We don't have to worry about banking instability. So there are good things about CBDCs. And current regulators aren't looking to use them in evil ways. That said, once you create a technology, you don't control how it gets used in the future. And so I think a lot of the concerns that are being expressed really are about what happens down the road. It is not about vilifying the government officials that are currently looking at creating these systems. And also personally as an attorney, I think a lot of those problems can be addressed by putting courts in the loop to protect individual rights before government officials can make use of some of the potentially tyrannical aspects of this technology.
If I could just, kind of piggyback off of that, and I'll pull like a global parallel for some of like what we're seeing. So, recently Zimbabwe came out with a gold-backed or partially gold-backed CBDC, right? And I was recently asked to comment on, whether this would be attractive or there would be significant uptake, right? And I think what, people sometimes fail to understand is that a CBDC is just an instrument, and an instrument that's backed by some form of trust. And that trust has to rely still with government. So just like technology in Web 2 didn't solve every single problem we had with transparency, accountability, governance, trust, I think you're going to find that a lot of the same concepts, if you're pulling them from a standpoint of like a CBDC, it's going to go back to the degree to which people can trust, just as they do with fiat money, the underlying government that's going to be supporting, promulgating, managing, and facilitating ongoing sophistication of that tool into the future. One thing that I just want to do is like a point to counterpoint. I think that's kind of fun is, people are always like, well, we can't trust the government with a CBDC. Oh, yeah? Can you trust the private sector? How well did Web 2 companies do with your personal information? How well, think about it like this. There's always going to be difficulties. There's always going to be challenges. What our job is, as creators, as innovators, as entrepreneurs and policymakers, is to minimize, mitigate risk, and try to create prosperity for all to the best extent that we can. And whether that is a trust-based system or a trustless system, I think it's important for us to continue to have the freedom and space to evolve, innovate, and to create. And I think above and beyond, that's the piece that needs to resonate most all.
All right, well said. Now let's go on to the final portion of the panel, which is states. There's a lot of things happening in many states in the United States around cryptos and blockchains. Starting from way back in the day when New York had the BIT license, and for better or for worse, they kind of set a standard on how we, as companies and as individuals, try and get statewide regulation for BIT licenses and our own companies. We're going to start with Gabriella. And she's going to give us an update what's happening in Illinois, I believe we said. And then we're going to have Chris do California, and we're going to just free flow from there. So, Gabriella.
Sure. This past 3 to 4 months, we were kind of laughing. It's like, the Global Digital Asset and Cryptocurrency Association had a lot of activity back home. We're based in Chicago, Illinois. Illinois had promulgated draft legislation under the name of Illinois Digital Asset Regulation Act, or Illinois DARA. I think what you're seeing is that when there is a failure at a national level to move legislation forward that creates clarity and helps to support businesses to grow and develop, there's increasing pressure at a state level, in particular amongst regulators, to do something, especially when there are large-scale collapses, fraud, scams, and other types of illicit behavior that's happening in the digital asset space. This is particularly acute when the industry itself can't seem to get to the point of more mature or advanced self-regulation. And so it then becomes incumbent upon your regulators to be doing something, because otherwise they get hauled before their state legislatures and people say, why didn't you prevent this? So at the Illinois level, we had a scam. It was an open Ponzi scheme. It talked about crypto. It didn't really have that much to do with crypto, but it was crypto adjacent enough that it drew, and highlighted some of the need for there to be an elaborated legal and regulatory system in the state. I think what we found is that although people were acting from the legislative side and regulatory side in goodwill to try to create something that worked for the state, there was just still a lot more that needed to be done. And I think, we come back once and again, if you could draw like sort of a spiral root cause analysis to the fact that nobody can define a digital asset and a security or a commodity around this. It keeps coming back over and over and over again. And that, again, was sort of at the heart of what was wrong or challenging or potentially harmful with Illinois DARA. And, what we found was that the definition was extremely expansive. It captured everything from like NFTs that would be produced by college students in a dorm, all the way up through, actually speculatively traded digital assets, right? What our role was very much, what I've done in emerging economies. It's community mobilization. It's bringing people to the table, helping to raise voice, being representative and inclusive in terms of small business views, perspectives, and ensuring that in a rapid fashion, we were downstate, educating, ensuring that legislators understood what digital assets are, not just for trading and, ooh, wahoo, the new meme coin today, but Why is it important for privacy? What does it do for supply chain logistics? How can it facilitate equitable housing? In what ways are we watching some of these opportunities arise for supporting, traditionally marginalized groups through ZK roll-ups and other forms of support, conditional cash payments, et cetera, et cetera. And so, that narrative, not the narrative of, woohoo, I made a lot of money in a 24-hour period, but the narrative around what the power, utility, and value of digital assets is, needs to be driven. And so what we found with Illinois DARA, we've collected all of the templates, everything that we've produced. We will be working to kind of create almost a playbook for state associations if they'd like to look at what we did. It's not perfect, again, but maybe if somebody finds themselves in a similar situation, cuts down on some of the time, helps them to mobilize, and hopefully have a greater presence. Because at the end of the day, just like the decentralized nature of blockchain and digital assets itself, a lot of the policy work, a lot of this support, it can't be overly centralized with one company, one founder, or one voice. It has to be shared, disparate, but coordinated.
Well, thank you. So I'm going to go from Illinois to California. And Tyler, I'm going to give you the last word when we close out the panel. So, Michael.
All right, so
Chris.
So I'm going to try to make this as quick as possible because there's quite a few things happening in California, but I wanted to take a quick step back because, so from a licensing perspective on money transmission, there's 50 states with 50 different licenses, okay? Right now, it's very difficult to go into all these different states to get a license. So currently, the Conference of State Bank Supervisors, the CSBS, has model law that is basically to harmonize money transmission across all the states. This has kind of been happening in the background. They haven't really been talking about it. It's not very public. And there is a what they call Article 13 in this model law. Right? And this is just a template law. Model law means it's a template. They hand it to all the states, and the states can basically enact it as they want, or they can tweak it, but at least all the states are using the same definition, same language, and most of the language is the same for the law. So essentially, in this situation, what they've done is they've passed, or a bunch of states have taken this model law, and some of them are passing it with the virtual currency carve-out, which came from the ULC, the Uniform Law Commission's Uniform Regulation of the Virtual Currency Businesses Act. This was also a model law that was introduced back in 2017, which was for how businesses should be licensed. So now, today, we're looking at a bill in California, AB 39, that's going to a license. And unfortunately, this bill has some really bad language in it. Like specifically, and I'm just going to touch on one major point, is an example would be if I'm a California resident. I'm here in DC. If I went to a Bitcoin ATM, I would not be able to purchase Bitcoin because I would be blocked because the company would need to have a California license to do business with me in DC. Now, I don't know where, other than New York, right, that any state has the jurisdiction in another state. This shouldn't happen. It should not be allowed to happen. And the odd thing is that California passed a bill in September of last year, SB 1498, where it says that a person must be located in California. This is for money transmission. So they're introducing law that contradicts the law that they just passed in September. So I'm pretty sure the last bill that went to California for licensing got vetoed by the governor. I have a feeling that this one will also get vetoed. But there's a few other bills that I'd like to touch on real quickly. There's a kiosk bill that's going to tell people who run kiosks exactly what they need to do. It's very prohibitive. It's not going to be basically the companies that I've talked to are going to leave the state if this gets passed the way it is. The $1,000 max transaction per person per day and a 2% or $5 fee. And there's no way any of these businesses can survive, right? So that would just kill it. There is some cool stuff going on. There's AB 1229, which helps define what a DAO is and fits it into a legal structure for tax purposes. And it has things like you must have at least 100 members. So it's really kind of trying to help get some legitimacy behind a DAO which I think is good for clarity because DAOs need to get access to banking and other things too, and they're kind of like nonprofits, so it gives some structure for that. And then one of the last things for California that I'll talk about is AB 76. This is a bill for money laundering for digital assets. And it doesn't say that digital assets on a blockchain are now considered money. They can just be considered, for the purposes of money laundering, money. So I don't understand how you can say that it's money for the purposes of money laundering, but when it comes to like the banking side of things, it's not money. So really what it just feels like is it's a carve out to go after operators that when and if, and then the language is very gray around what is money laundering and how you define it specifically, meaning if you get to a point where it basically comes down to, did you know or did you not know you were like facilitating illegal transactions? And if you have a blockchain hash on a certain day at a certain time, the regulators and the law enforcement just have to point to this happened on this day at this time. How come you didn't know? And then it's a he said, she said, or he said, whatever it is. And the next thing you know is you're in trouble and you can't necessarily defend that position. And so it really opens up people to operators, both exchanges and issuers, the ability to go to jail. So these are very, very prison. These are the things that are happening in California right now. And then a couple other things real quick. So there's a bunch of bills that have been passed. South Dakota passed a bill for money transmission that includes virtual currency. So did North Dakota. Minnesota has just passed one last week. And Nevada passed one, but they've already been doing virtual currency. And Alaska had one on the books, but they decided to table it for this time around. So there's at least 3 other states that have introduced licensing for cryptocurrency and virtual assets, and it's really flying under the radar.
Tyler, you got the last word.
Sure. Yeah, I think all of the proactivity by the states has been great. I mean, the virtual currency legislation. Initially, when we first started looking at money transmitter laws from a state level, there were 3 schools of thought. There was either no, we don't consider money or virtual currency to be money, and therefore the transaction of money by an intermediary is not money transmission. Yes, we do consider it money, and we want to regulate that. Or it depends. Sometimes, if you're working with consumers versus institutions, you may or may not be characterized as a money transmitter. And so states are being incredibly proactive with solidifying their interpretations through guidance and through actual legislation now, and that's very productive. And we just need, I think, more productivity at the federal level, and we're seeing that. And I hate to, we talk about all the lack of clarity, but I think what's optimistic is we're at an inflection point here in 2023 where there's going to be a lot decided. We have potentially a decision in the Ripple case that could be impactful. We have regulators testifying before Congress. We have regulators being challenged in courts to defend their thinking and analysis and present it to the public. And so I think all of that's really optimistic for the industry as a whole. And I think 2023 is going to be just a big year to continue on the developments in the regulatory sphere and add clarity for the benefit of innovators in the space, which is so desperately needed.
All right, let's hear it for our panel. Gabriella, Chris, Michael, and Tyler. Weren't they awesome, folks? I'm Eric Guthrie. Thank you. I look forward to talking to all of you for the rest of the conference.